Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 13th of March. US employment data cement a March hike. The US economy added 235,000 jobs in February, data showed on Friday, a number consistent with further tightening in the labor market. The unemployment rate ticked down while the labor force participation rate ticked up, indicating both an increase in the number of people available to work and a decrease in the number of unemployed people. However, wages disappointed again, with average hourly earnings rising at the same pace as in January and below consensus. Nonetheless, in yearly terms, earnings accelerated. Even though wage growth missed its forecast, the print is not soft enough to derail the Fed's plans for a rate hike this week, in our view. This is evident by the fact that the probability for a March hike remained almost unchanged at roughly 90%. The reaction in the dollar was negative on the news, perhaps as investors found an opportunity to lock in some profits on their long USD positions ahead of Wednesday's FOMC meeting. Now in Europe, the common currency jumped during the European afternoon Friday, following a Bloomberg report that at the latest ECB meeting, policymakers debated whether interest rates could rise before the QE program actually ends. We think that these policy signals could keep the euro supported over the next few days, at least in the absence of incoming French polls showing that Le Pen is gaining back ground on her opponents, and also assuming that the Dutch Eurosceptic candidate Wilders does not win Wednesday's election. Euro and dollar surged on Friday due to the combination of the soft US wages and the ECB reports, breaking above the 10630 key barrier, which acted as the upper bound of the sideways range that had been containing the price action since the 17th of February. This has turned the short-term outlook to positive in our view. Now the rate looks ready to challenge the 10710 resistance barrier, where a clear break is possible to extend the rally towards the 10755 area. Switching to the daily chart, although the pair is still trading below the downtrend line taken from the peak of the 3rd of May 2016, we prefer to switch to flat for now. The recent rally confirmed a bottom near 105, while it made it clear that an inverted head and shoulders may be in the works. A clear close above the crossroad of the aforementioned downtrend line and the 108 key resistance is possible to signal the completion of the pattern and bring a medium-term trend reversal. Now moving to the energy market, oil prices dropped again on Friday following the release of the Baker Hughes recount, which showed that the number of active US oil rigs continued to increase. WTI tumbled after it hit resistance at 50.50 and stopped at 48.40. Last week's slide is in line with our long-held view that following the OPEC consensus, higher oil prices would invite US shale producers back into the market, thereby keeping a lid on oil price gains. Therefore, we expect the precious liquid to remain under pressure, at least in the short run. We would expect a clear dip below 48.40 to open the way for our next support of 47.50. Nevertheless, we would stay careful that a corrective bounce may be on the cards before the bears take the reins again, given that the latest slide looks somewhat overextended. With regards to the bigger picture, although the price is still trading above the upside support line taken from the low of the 5th of April, the fact that US producers are making a comeback makes us hesitant to trust WTI's longer-term uptrend. We believe that the likelihood of last week's correction leading to a reversal is not something to overlook. As for today, the only event that could attract some attention is in the UK, where lawmakers of the House of Commons will debate on the Brexit bill amendment proposed by the House of Lords. Although unlikely, any signs that the Commons could support the amendment as well may prove positive for sterling. As for the rest of the week, on Tuesday during the Asian morning, we get China's retail sales, industrial production and fixed asset investment data for the months of January and February. From Sweden, we get CPI data for February. On Wednesday, the highlight will be the FOMC rate decision. The committee is widely expected to hike borrowing costs, so we don't expect a major market reaction in case the Fed simply acts as expected. Investors are likely to quickly turn their attention to the updated dot plot for fresh signals on the rate path, as well as Chair Yellen's press conference. In terms of political events, market participants will keep an eye on the Dutch election. On Thursday, we have an extremely busy day with 4 central bank meetings on the agenda: the Bank of Japan, the Swiss National Bank, the Norges Bank, and the Bank of England. All of these banks are expected to remain on hold. On Friday, we have no major events or indicators on the economic agenda. For more information, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.